In 2007, Venezuela thrived with a booming GDP. However, 2013 heralded changes. The country, heavily reliant on oil exports, saw the value of a barrel plummet in 2014, triggering a crisis. Having oil can be beneficial, but its management is crucial. Venezuela is not the only one affected. Many resource-rich countries face similar challenges. Possession alone does not guarantee prosperity. It's vital to know how to harness them correctly. Inadequate management can harm both the economy and the citizens' well-being. This phenomenon, where wealth turns against a country, is known as the resource curse. In the video, I will delve further into this curse, its impacts, and how Brazil positions itself in this context. Chapter 1: The Resource Curse. The resource curse is an intriguing concept. It posits that countries rich in natural resources may face economic stagnation, heightened corruption, fragile governance, and even violence. At first glance, this may seem paradoxical, doesn't it? However, Venezuela exemplifies this thesis well. With the world's largest oil reserves and abundant natural gas, coal, wood, and gold, you would expect prosperity. Instead, we observe an intense financial crisis. The nation grapples with food shortages, medicine scarcities, and even water scarcity. At times, even gasoline was in short supply, ironic for a country so rich in oil. To understand the origins of this curse and why resource-rich nations may stumble, we must rewind a few decades, specifically to the Netherlands in the 1960s. Chapter 2: The Origins. In the 1960s, the Netherlands had a major revelation. They discovered an immense natural gas reserve, the largest in all of Europe. Everyone believed this would strongly boost the economy. However, the opposite occurred: the economy contracted. The Dutch currency, with this newfound wealth, appreciated greatly. This had a side effect: it centralized the economy around gas. Local manufacturing, once thriving, began to lose ground. The export of other products was hampered. This unexpected economic setback received a specific name: the Dutch disease. This term suggests that an abundance of natural resources can lead to economic decline. It's not just the Netherlands that faced this. Venezuela, rich in oil, also found itself in a similar situation. When a country overly focuses on a single resource for export, it jeopardizes its economic diversity. Financial dependence becomes alarming. In the scenario of an oil-rich country like Venezuela, the oil industry comes to dominate. All attention, labor, and capital are directed towards it. After all, oil promises quick and abundant wealth. Meanwhile, sectors like agriculture, commerce, and manufacturing are neglected. The excessive appreciation of the local currency due to oil exports is another issue. If everyone desires to work with oil, previously profitable sectors start to suffer. They become more expensive, their production costs rise, and exporting becomes unfeasible. And there's a lurking risk. If, for any reason, the price of oil drops or depletes, the country faces a crisis. A study from the 1970s and 90s by Sachs and Warner supported this idea. They analyzed 95 resource-rich countries and concluded that the more a country exports these resources, the slower its growth. However, it's crucial to understand that the resource itself is not the villain. It's the improper management of it. Many resource-endowed countries have less democratic and more authoritarian governments. There's a parallel between the abundance of natural resources and democracy, as analyzed by Eifert, Gelb, and Tolroff. Some regimes are more prone to suffer from the resource curse. Norway. Norway is an exception. It knew how to manage its wealth and avoid the trap. It adopted long-term policies to diversify its economy. Another example is Botswana, which, although facing challenges, possesses many democratic features. But not everyone is like Norway or Botswana. In many places, resources are squandered. Political leaders and elites use these resources for personal enrichment. They manipulate revenues, seek popularity with short-term policies, and cling to power. During times of prosperity, wastefulness is common. Politicians invest in mega-projects, increase their own salaries, and expand benefits. When the tide turns and prices fall, reality sets in. Cuts are made, debts accumulate. These situations and their ramifications will be our next focus. Chapter 3: Nigeria. Nigeria is recognized as Africa's largest oil producer, a resource that constitutes 90% of its economy. It also holds reserves of iron, coal, gas, tin, and gold. In 2014, it was acclaimed as the giant of Africa, boasting the continent's largest economy. However, 8 years later, it faces severe challenges. Nearly half of Nigerians live in extreme poverty, plagued by inadequate sanitation, low HDI, and high infant mortality. Despite the wealth, the majority of the population resides in rural areas. State investment focuses on oil exploration and debt repayment, neglecting industrialization and the well-being of the people. Oil opulence centralizes in local elites and powerful transnational corporations, known as the Seven Sisters. The situation is further complicated by the presence of illegal refineries, a profitable yet risky practice, as per the BBC. Due to a lack of regulation, it's common to hear about billions going missing, as companies underreport earnings to reduce taxes. Local farmers suffer from contaminations originating from these activities, harming crops and fishing, and further limiting their options. Chapter 4: Venezuela. Venezuela holds the world's largest oil reserves, accounting for 18% of the total. Until 2007, its GDP was growing strongly. However, in 2014, with the fall in oil prices, it faced a severe financial crisis, evolving into a humanitarian crisis. This resulted in the migration of millions of Venezuelans. In the 1910s, the foundation of Venezuela's economy was agriculture, especially coffee and cocoa. Many relied on subsistence farming. But in the 1920s, with a focus on progress, the country invested in oil exploration. With vast reserves, oil became the main economic pillar. This attracted workers from the countryside to the oil industry. This concentration on oil made Venezuela highly dependent on imports. Currently, oil accounts for 96% of its exports. When the price of a barrel of oil drops, the country suffers. This pattern recurs in Venezuelan history. If oil prospers, the economy prospers, but the opposite is also true. In 2014, the price of a barrel plummeted from $111.87 to $48.07 in just 6 months. This deeply affected the country's economy. With reduced revenue, the ability to import diminished. Venezuela had no investment in other products besides oil. Almost everything was imported. With reduced imports, essential products were scarce. Markets were undersupplied, lacking food, medicine, and basic items. This resulted in one of the most severe supply crises in the world. Chapter 5: Saudi Arabia. Until 2010, Saudi Arabia had 75% of its economy tied to oil. However, in a bid to diversify, by 2018, this number had dropped to 55%. By diversifying investments, it became economically more resilient and expanded its range of exports. Such progress was motivated by positive examples of resource-rich countries that knew how to strategically leverage them. Nations like the United States, Norway, and Canada served as inspiration, showcasing how effective resource management can drive economic development. Chapter 6: Countries that Escaped the Curse. Natural resources can propel a country's economy. Norway, the United States, and Canada are examples of this. Political management is the differentiator in these countries. Let's look at Canada. In 2014, it exported oil, gold, automobiles, aluminum, wood, fabrics, and vegetables, among others. Canada is rich in minerals and hydrocarbons. These resources drive its industrialization. Agriculture is also significant: wheat and cereals. Its dense forests enable sustainable exports of paper and pulp. Industry is Canada's focus, with a notable presence in food, electronics, and transportation. Diversification is the key to avoiding dependence on imports or a single resource. The US, a producer of oil and gas, is not just a miner. It's an agricultural, technological, and industrial powerhouse. They produce electronics, software, and other products on a large scale. Norway, in turn, is a case study. In 1974, the oil boom almost led it into the resource curse. Other sectors suffered. As a solution, the pace of oil exploration was moderated. Part of the revenue was reinvested in technology and research in the sector. Understanding the finite nature of oil, the Norwegian Sovereign Wealth Fund emerged in 1990. This fund accumulates oil revenues and globally invests in stocks, fixed income, and real estate. The mission? Safeguard Norway's future, prolonging the benefits of oil, projected to last another 50 years. The value? Around 1.4 trillion euros, 5 times Portugal's GDP. The transparency of this fund inhibits corrupt practices. Norway doesn't stop at oil. It exports technology and oil machinery. With the profits, it strengthened its oil sector, making it highly competitive globally. Moreover, it's investing in renewable energies to diversify its energy mix. Norway, Canada, and the US have stable and democratic governments. Poverty rates are low. They understand that natural resources, though valuable, are finite. Their use needs to be strategic and diversified. And Brazil? Where does it stand on this spectrum? Chapter 7: And Brazil. In 2015 and 2016, Brazil was immersed in a deep recession. Many point to the significant drop in commodity prices in the second half of 2014 as the main cause. This decline interrupted the cycle of economic growth that was driving the country and fueling a credit boom. Braulio Borges, a renowned economist, examines this situation from an interesting perspective. According to him, Brazil has experienced a milder form of the resource curse. Borges believes that Brazil doesn't compare to the more extreme examples of this curse, but it is far from being a positive model. He observes symptoms of the so-called Dutch disease in Brazil, a decline in industry, an overvalued exchange rate, and persistent corruption scandals, such as the Petrolão. Additionally, there is the volatility of asset prices and the presence of fragile institutions. Borges argues that the solution to this instability lies in the implementation of robust institutions. These structures should be designed to prevent the vicious cycle of booms and recessions, particularly related to commodity prices. He also suggests careful capital control, avoiding a credit surge when the economy is on an upswing. Recently, Brazil has gained prominence in the global oil scene. Projections indicate a daily production of 3.7 million barrels by 2023. In comparison, in 2021, the country produced about 2.9 million barrels daily. If this pace continues, Brazil could solidify its position as the sixth or seventh largest oil producer in the world. However, this prominence comes with an increasing risk, dependence on this resource. Merely extracting and selling oil on the international market could represent a missed opportunity. It would be more strategic to convert this commodity into an engine that drives the economy, encouraging innovation and research. Looking at Norway, we see a successful example. The Nordic nation not only capitalized on its oil resources but also invested in specialized machinery for the sector. Thus, they transformed a raw resource into something that permeates and strengthens the entire economy. The lesson is clear. Brazil has the chance to follow the Norwegian example by investing in advanced technologies and diversifying the economy. However, currently, the country seems to be following a path more similar to Nigeria, missing valuable growth opportunities. What are your thoughts on all of this? Do you believe that Brazil will be able to overcome the resource curse? Leave your comment. I'm curious to hear your opinion.